Don't pick stocks, pick businesses, the secret sauce of Warren Buffett's success. Warren Buffett is widely recognized as one of the most successful investors of our time. In his latest letter to investors, he revealed the secret sauce that has led to his and his longtime business partner Charlie Munger's success, being a business selector rather than a stock picker. Buffett expands on this concept, explaining that it involves investing in businesses with favorable long-term economic characteristics and trustworthy management. It is a simple technique that has yielded significant returns for value-oriented investors over the years. The goal of this approach is to find outstanding businesses, buy and hold their stocks for as long as possible, regardless of market fluctuations, as long as the business continues to grow and has a future. Of course, it is easier said than done. Selecting businesses that can consistently outperform the market in the long run is not an easy task. Fortunately, Buffett and Munger have outlined 4 rules they follow when choosing which businesses to invest in, which we can also apply to our own investment strategies. 1. Do you understand the business? It is not enough to know how a business operates, you must also understand what value it provides to its customers. You should be able to envision where the company will be in 10 years, or even better. Buffett advises, if you aren't ready to own a stock for 10 years, don't even think about owning it for 10 minutes. Many people may recall that Berkshire Hathaway, Buffett's holding company, missed out on investing in Google and Amazon in the early 2000s because Buffett himself did not understand those businesses. He refrained from investing and had no idea how profitable they would become in the long run. While some may view it as missed opportunities, we can also see it as a prudent move that emphasizes safety, as Buffett's first rule of investing is, don't lose money. Even though Berkshire didn't invest in Google or Amazon, they have still made handsome profits from other excellent stocks such as Coca-Cola and American Express over the past few decades. 2. Does the business have a sustainable competitive advantage? One of the most crucial factors for long-term business success is having a sustainable competitive advantage. Buffett compares it to having a moat protecting the business, making it difficult for competitors to enter the industry. The stronger the moat, the harder it is for rivals to disrupt the company's position. For example, the secret formula of Coca-Cola is a massive moat that no other brand can surpass. Similarly, in our own country, we have 7-Eleven dominating the convenience store market or Makro leading the wholesale industry. These businesses have substantial competitive advantages. 3. Do the business's managers possess honesty and ability? This is perhaps the most crucial factor and the ultimate measure of success in all 4 investment rules. Buffett looks for 3 qualities in the management or leaders: intelligence, energy, and integrity. Among these, integrity is the most important because without it, the other 2 qualities can lead to disastrous outcomes. In his 1998 letter to shareholders, Buffett wrote, "We don't have to partner with managers who lack admirable qualities. No matter how attractive the economic prospects of their business may appear, we have never succeeded in making a good deal with a bad person." When integrity is present, trust follows. This means Buffett and Munger don't need to micromanage or scrutinize the businesses within their conglomerate. They entrust decision-making to people they can rely on. They compare finding managers to finding a dance partner, emphasizing the importance of trust. If they find trustworthy managers, they delegate decision-making to them without hesitation. 4. Is the price justified? One important aspect of Buffett's and Munger's investment approach is to look for good businesses at prices that are reasonably lower than their intrinsic value. Warren Buffett, the legendary investor, emphasizes the importance of choosing businesses over stocks. He believes that the key to his success, along with his business partner Charlie Munger, lies in being a business selector, rather than a stock selector. According to Buffett, being a business selector means investing in businesses that have favorable long-term economic characteristics and trustworthy management. It is a simple technique that has yielded significant returns for value-oriented investors. The goal is to find excellent businesses, buy their stocks, and hold them for as long as possible, regardless of short-term market fluctuations, as long as the business continues to grow and has a promising future. However, while the concept is straightforward, implementing it is not always easy. Choosing businesses that can consistently outperform the market in the long run requires careful analysis and understanding. Buffett himself missed the opportunity to invest in Google and Amazon in the early 2000s because he didn't fully comprehend their businesses and couldn't predict their long-term profitability. Nevertheless, Berkshire Hathaway, Buffett's holding company, has achieved remarkable profits from investments in strong businesses like Coca-Cola and American Express over the past few decades. One crucial aspect to consider when selecting businesses is their sustainable competitive advantage. Buffett compares it to having a moat surrounding a castle, protecting the business from competitors. The stronger the moat, the more difficult it is for competitors to enter the industry. For example, the secret recipe of Coca-Cola or the dominance of 7-Eleven and Macro in their respective markets exemplify businesses with significant competitive advantages. Another vital factor to assess is the integrity and ability of the business's management. Buffett considers three qualities in leaders: intelligence, energy, and integrity. However, integrity is the most important because without it, the other two qualities can lead to disastrous outcomes. In a letter to shareholders in 1998, Buffett stated that he never succeeded in doing good business with bad people and emphasized the significance of trust and honesty. In summary, Buffett's secret sauce for success is to be a business selector rather than a stock selector. It involves understanding the business, its long-term prospects, and the value it delivers to customers. Sustainable competitive advantage and trustworthy management are key factors to consider. While it may seem easier said than done, applying these principles can lead to successful long-term investments.